everyone. My guest today is Lead Analyst Logan Mohtashami to talk about inventory and how we get sub 6% mortgage rates in 2026. First, I want to thank our sponsor, Trust and Will, for making this episode possible. Logan, welcome back to the podcast.
It is great to be here. You are in Minneapolis?
I'm in Minneapolis at the NRMLA, the Reverse Mortgage Lenders Convention, and you are in DC?
I'm in Washington. It has been a while since I've been to DC, so I got to go to the Capitol, the Monument, and stuff. So it's good. Next time I'm here, I'm going to be able to get into the White House. So good times.
Good times. That's amazing. Yeah, you're there during the shutdown. So what we want to talk about today is mortgage rates under 6%, which when you were like, hey, let's talk about that, I was like, okay, I want to talk about that all day long. How do you see mortgage rates getting under 6%? What's the time frame there?
So this is not a 30-year fix call. Obviously, with how I forecast mortgage rates and the 10-year yield, it's very hard to get mortgage rates below 5.75% with Fed policy and the spreads where they are. If spreads were normal today, you would have sub 6% rates. But to get kind of below there, you need a more dovish Fed, normal spreads. So this is not going to be a 30-year fixed call. But what's happening now is now that short-term rates are coming down, the ARM loans are sub 6%. So technically speaking, if you do get two rate cuts in the next two meetings for the Fed, you will have the ability, even now, to have sub 6% mortgage rates for all of 2026. Which,
wow.
Now for me, it's a little bit different. You remember the time I talked about like banning all ARM loans?
Yes.
So obviously back then, when you're part of team higher rates, you need inventory to grow. One of the things that I was concerned about is that 4 to 5% mortgage rates were not doing the damage that I thought it would do. So to me, that was a little bit concerning. Now that we're in October of 2025, think about if mortgage rates never went above 5% and how it would have been so much more difficult to get inventory up to a level where you have a healthier marketplace. So back then when rates were at 6 and they were creeping back down to 5, I was like, we need to just ban all ARM loans and make sure that, 30-year fix can stay elevated enough to get inventory up. 6 to 8% mortgage rates really since 2022. That range has gotten inventory. We're not back to normal, but we're in a healthier marketplace. And we'll talk about inventory a little bit later. But here, because housing data looks so much better with sub 6% rates, I mean, the builders, new home sales still at 2019 levels. New home sales just hit a 3-year high on a monthly print, which will probably get revised lower. But for the first time, it's like, okay, this actually might be a thing because we're already seeing more ARM loans being picked up already. And the ARM loans now are so much different than what they were from 1996 to 2005. And I never thought they have the ability to grow because the qualifications are different. You have to qualify for the recast payment. By the time the loan recast wages have already gone up for you quite a bit. So it's a much safer product, but it's much harder to get and you don't really gain the massive benefits. But here, in this unique situation with this cycle and that sub 6% mortgage rates work, this can be a thing for the rest of this year, but also all of 2026, especially as the Fed cut rates. And we talked about that a few months ago, how Trump wants to attack the Fed can actually boost ARM lending. But I'm starting to see a little bit, and the MBA, the Mortgage Banking Association, has talked about this a bit too, that ARM loans are starting to pick up. Now, because they're harder to qualify for, they're not going to have the very high velocity of the credit boom that we saw from 2002 to 2005. But this can be a story now going out for the rest of this year, but all of 2026. When I always say that ARM lending can't grow like it did back then because it's much harder to qualify, these are like, you couldn't have two different type of ARM loan lending than 2002 to 2005 than from what we see from 2010 all the way to 2025. And this is why the percentage of ARM loans are historically low. They do tend to pick up a little bit when rates go up, but now we're just in a very unique situation to where you have a mass amount of people that seems to like the sub 6% mortgage rate.
Right.
And the builders can show you this by what we talk about is having 2019 home sales equates to 1 to 1.2 million more existing home sales. Now, I don't like to do it apples to apples because the new home sales market is a little bit different. But the fact that the builders are still up here and the existing home sales are still up here, and the existing home sales tend to get better when rates just get down towards 6%. This is the first time in this cycle that you can have a period of time, because short-term rates have gone down, that the ARM lending can pick up. But again, there's limits because you got to qualify for it differently, and you got to qualify for the recast payment out there. And so it'll be interesting to see, because I never thought this would be a thing ever, right? We wouldn't get in this unique situation where people go, hey, listen, I just really like the sub 6% rate. I'm going to go in there. And we've seen people do that with the builders. But it'll be a fascinating experience. And because I'm seeing some of that happen already, it is something that has the potential to grow because we're working from such low levels. Again, whenever you're working from very low levels, the percentage increase can go up higher. But it'll be an interesting aspect for 2026.
Who is a good candidate for an ARM loan versus another loan? So to your point, like there's this recast rate. Is it someone who's younger, who's just starting their career? Like, what does it look like?
I don't think anyone is better qualified or not qualified, because I think housing is the cost of shelter. Like when people ask me, should I buy a home? And when I say no, because you're asking me,
Right.
you're not emotionally and financially ready to ever own a house. And again, I'm at the point of saying you should not even own a coffee maker at this point.
You're so brutal
But the
about it. People
people,
are just asking you.
listen, Sarah. It's like if I came to you and say, Sarah Wheeler, hi, you don't know who I am, but should I be a writer? And you don't know anything about me, and our job in economics is to talk about the housing market and in the natural ecosystem. But to me, if you're a grown adult and you have to ask somebody if you should buy a house, you're so not ready. You're just so not ready. And there's millions of people that buy homes every year. They're ready, but you're not. And the day you don't ask someone, like if you lived it with your parents or you're at a dorm, got roommates, maybe you should just stay there. You're not ready. But to answer your question, I always think that it's just the middle and higher income brackets are buying the homes, right? That's just kind of what we see in the data. But for those people that are looking, that are getting ARMs, you look at the new home sales sector. The typically new home sales sector are wealthier, higher income brackets that are older. So in this context, I don't think there is a category of a person, nor do I believe there should ever be a category of person. It's a person that looks there and says, okay, I have X payment. Let's say I will never be able to refinance this loan ever again in the history of America, and this is my recast payment, and that'll be completely fine. So you should always buy a house thinking you will never, ever, ever have a lower rate than what you have currently, but your wages rise, right? And that's the housing discussion that never gets discussed about. You buy your house X, but your wages typically rise. Now, of course, there's some people whose wages fluctuate like crazy, but don't look at it as who's the right person. The person themselves has to look at, hey, this is the payment. This is the recast payment for 25 years. I don't know if I'm going to sell this house in 10 years. I don't know if I'm going to be here for the next 30 years. But the only person that should even think about this is somebody that says, okay, I'm good with this payment, and then I'll be good with the recast payment, and I'm good all around. That's why I don't like categories, because I don't want certain people to buy homes. I don't. There's a lot of men in this country who should not own a coffee maker. Have you seen these people online? They are so Fraggle Rock fragile people, man. I mean, they're just panicking all the time, and these guys, like I always say,
Fraggle
I
Rock, I
understand
love it.
when yeah, when the ladies say there's no good men out there, and I go, this group, these are not homeowners, home buyers, man. They panic out. They see the dollar go down a little bit, and God, we're about to go collapse. Those are not homeowners. So again, to answer your question, there is no category. The person goes there, looks at the payment, and says, I will never be able to refinance for the rest of my life. I'm okay with that recast payment. And you're good. Wages rising. You have so much to do with in your life. Your mortgage payment should not be something you ever worry about. So the person that says, hey, listen, the recast payment will be fine 5-7 years from now, but now, get a lower rate. That's who I think should get it. Are those the people that will get it? Not all of them, but that's what I always thought about housing. That's why I love the 30-year fix. I'm a 30-year fix guy always, right? I'm only having this conversation because the data shows that this is starting to pick up and short-term rates are coming down, and the gap between the ARM loans and the 30-year is getting wider and wider out there. And when I always say this is the lowest home sales ever recorded in history, I'm talking about the existing home sales market, and I adjust it to the population out there. Of course, new home sales are still elevated, but when we look at total home sales, it's still near 5 million. And the total home sale peak in the last decade was near 6 million. So you're missing like 1 million mortgage buyers roughly from what the peak was in the last decade out there. So I see that this is something that could potentially grow sales, just because for some reason the sub 6% mortgage market seems to be the winner out there, and the builders have taken advantage of that as much as they possibly can with their profit margins.
So I want to dig in a little bit here because, when you started out talking, you were like, you were team higher rates because we needed higher rates than 4 or 5 coming off of COVID to get prices back in control. And I think that it's easy in our industry to think, oh, lower rates are always better, or, everyone's business would be better with lower rates. But it's not a better business if you don't have a healthy enough market. If you have 25 people competing for a home, that's a lot of people wasting their time, effort, energy to try to get those people, in a good application, to get them pre-qualified, to get them through the process, that are never going to get a home. So it's interesting to me that you're like, inventory is a really important part too.
So to this point, I think people forget this aspect. In the last decade, we had mortgage rates between 3.25% and 5% for like 10 years. We didn't have a housing problem, right? It never existed, even with mortgage rates in the sub 4% mortgage market. Why? Because total active inventory was higher. And I don't believe in a housing sales boom. I don't believe because of qualified mortgage, we cannot have a credit sales boom like we saw back then. But in this context, when inventory got to such a low level, it just was such an unhealthy housing market. And nobody understands that shortages are the worst of everything, because you're basically bidding, for prices on something that should not have had it. And just getting back up to here, this is why I like 2025 housing more than any other years of the past. It looks like a very normal supply and demand equilibrium, buyers versus sellers. Buyers are now part of the game now. That's what you needed to see. And that's the healing process of it. Now, if active inventory was back down to those levels that were unhealthy, I'd be telling you, ban all ARM loans. ARM loans are for giving you sub 6%. I would sit here and say the same thing. But now that we're here, we have a cushion, right?
Yeah.
We have a cushion out here, and much healthier housing market, because housing is going to be here for decades and decades and decades and decades. What we saw from 2020 to 2022 was savagely unhealthy. But, we had prices escalate out of control from 1943 to 1947. We had prices escalate out of control from 74 to 79. When I tell people home prices grew faster from 77 to 79 versus 2020 to 2022, and rates went from 8 to 13% back then. And
Whew.
here, rates were, sub 4% during that period. This was a supply story. This was just a simple supply story. The supply and demand equilibrium broke. And because a lot of people don't look at economics as a supply and demand equilibrium, they didn't realize how bad housing was in 2020, all of 2021 and early 2020. But that's no longer the case. And this is why we can have this discussion here today.
We are not, it's no longer savagely unhealthy. It's not even maybe unhealthy. What would you call it? Healthy? Stabilized?
Oh, no, this is the healthiest market post 2020. Absolutely. No doubt. Days on market are up. Price growth is very low. I might not get my price forecast this year, but it's still, home prices be negative, adjusting to inflation, depending on how you track inflation. Positives, because every year that happens, housing gets a little bit more affordable because of wages and households. And that's what you needed. You couldn't do this. Like 2023 is a really good example. 2023 was terrible because prices went up 6%. New listings data was trending at the lowest levels ever, and home sales were low, right? If prices were just basically flat that year, I would consider that a healthier marketplace. But here, you've got a little bit of everything. Just to give everyone an example, Moody's has this home price valuation, and they said, a few years ago, home prices or home values were 29% overvalued compared to historical norms. Well, now that's down to like 7-8%. It's because price
That's much
growth
better.
has cooled down, right? And wages growth. So it's an equilibrium that nobody really wants to talk about because it talks about wages and households and rates and payments and everything. But we really needed that to happen for this to work for the next 20, 30, 40 years. And it worked in that. Of course, you needed you need the biggest crash in home sales ever. You need 3 years of the lowest home sales ever in history. And that's what it took to get back to the low level of 2019 inventory, the low level, it's the best you could hope for in this situation.
So you just need a catchy catchphrase for it, something snappy, because savagely unhealthy caught on. Everybody, you were on TV a lot talking about it. We talked about it. But when you're like, oh yeah, this is the healthiest, it's like, I don't know. We need something snappy there, Logan.
There'll be a cap phrase when I get what I want. I really, really want active inventory to start a year at 1.52 and just range between 1.52 to 1.93. That was my goal all the way back in 2022. I didn't get that this year. I got to the low end, but there's a catchphrase for that once I get what I want out there. So I'm just mindful of it because, again, after 2010, the whole supply and demand equilibrium for housing economics have changed, just like the whole structure of the U.S. economy changed with qualified mortgage and the bankruptcy reform laws. 70 to 80% of home sellers are buyers. 20 to 30% of inventory gets left behind. If mortgage buyers grow, especially from first-time home buyers or those that don't provide a house, inventory has the ability to stay flat or go lower. We just needed a little bit of room up to create a buffer out there. And since we're not going to get 3-4% mortgage rates or anything like that, I don't have to worry about, inventory just collapsing down again. What I want is the chef kiss of everything. Rising inventory, rising sales, 80s, 90s, 2000s. We saw a little bit of that last year, which I was like, oh, I got giddy. Even more giddy than the 49er Ram game. But it was just like, that is what housing looks like. And I'm hoping we can have some form of that, especially in 2026.
Amazing. Well, we are out of time. Logan, thank you so much for being on from DC and Minneapolis. Thanks for being on. Thanks for walking us through.
My pleasure.